The GST provisions contain certain rules aimed at insurance transactions. General insurance policies, such as motor vehicle insurance and house and contents insurance, are subject to GST. However, some insurance policies are not subject to GST, such as health insurance and life insurance. INL Limited is a company that provides building and motor vehicle insurance to the public. INL Limited is registered for GST and has both personal and business customers. The provision of insurance by INL Limited is a taxable supply, and GST must be added to the premiums. If the customers are GST registered and use the insurance for a creditable purpose, they can claim an input tax credit on the insurance premium. When a customer makes a claim under their insurance policy, the insurer's settlement of the claim is not a taxable supply for either the customer or the insurer. Assume a GST registered customer running a delivery business had their delivery van stolen. In settlement of this claim, INL can either pay them $60,000 or directly provide them with a new van worth $60,000. In either case, there is no taxable supply for the customer or for INL. Where the insurer directly pays a third party in settlement of a claim, such as a panel beater to fix a car or a tradesman for housing repairs, an input tax credit can be claimed by the insurer on such amounts. However, the insurer would need to make an increasing adjustment for any excess paid by the customer. Assume INL has a customer that sustained a loss to their house in the amount of $22,000. Under the insurance contract, this customer is subject to a $1,000 excess. INL then pays a builder $22,000 to fix their loss. Here, INL can claim an input tax credit of 1/11 of the $22,000, being $2,000. However, as the insured customer had an excess of $1,000, INL must make an increasing adjustment of 1/11 of this, which is $91. This is to balance the fact that, to the extent an excess has been received, INL has only in net terms spent $21,000 on the repair. Note that the payment of the excess from the customer to INL does not lead to a GST liability or entitlement to an input tax credit. In some situations, settlement of an insurance claim can lead to a decreasing adjustment for the insurer. This is the case where the customer is not registered for GST or does not use the insurance for a creditable purpose. If the customer has an entitlement to a full input tax credit for the insurance premium, then no decreasing adjustment is available for the insurer. Assume a customer of INL is registered for GST, has a $1,000 excess, and has a shop that suffers fire damage. Repair costs amount to $55,000. As settlement, INL pays the customer $49,000, representing the cost of the repairs to the customer, less the $1,000 excess and the $5,000 of input tax credits that the customer can claim. The situation becomes more complex when the customer cannot claim full or any input tax credits on the insurance premium. Assume one of INL's customers is a private homeowner with a $1,000 excess. Their house was damaged in a fire and repair costs amount to $55,000. Here, INL would pay the customer $54,000 in settlement of their insurance claim, being the repair cost less the excess. INL would then claim a decreasing adjustment to balance the fact that the customer is not entitled to get any input tax credits for repairing their house. This adjustment would be 1/11 of the settlement amount of $54,000, being $4,909. The calculation becomes more complex when the customer is entitled to a partial input tax credit on the insurance premium. In such a situation, the decreasing adjustment is subject to a formula. Assume a customer of INL is a business customer that is registered for GST. The customer has an input tax credit entitlement of 70% on the insurance premium for its building premises, as the premises are used 30% for making input tax supplies. The customer's premises are damaged and INL pays them $200,000 as an insurance settlement. Under the above formula, the settlement amount can then be calculated. The calculation then results in a decreasing adjustment for INL, representing the 30% usage for input tax supplies. These decreasing adjustments by the insurance company will be based on information that the customer has communicated to them regarding their entitlement to an input tax credit on the premium. Sometimes the customer might not have informed the insurance company of its entitlement to an input tax credit on the premium. In other instances, it might have understated its entitlement to an input tax credit. In such circumstances, there will be an increasing adjustment for the customer, so as to balance the fact that the insurance company overclaimed its decreasing adjustment. To recap, while most general insurance premiums are subject to GST, settlement amounts are not. The payment of customer excesses and the inability of customers to claim full input tax credits on their insurance premiums can potentially lead to increasing and decreasing adjustments for the insurer on settlement of insurance claims.